Welcome back to the Wolf of Property and Casualty. I'm your host, Derek Lasniak, with over 15 years of commercial broking experience focused on the middle market, upper middle market, national account space. Topic for today is builder's risk insurance. And the reason I selected this is not because I have a ton of experience, and I'll get to that in a second. The reason I selected this is because, again, as I have more time to read insurance periodicals, I am inundated with the amount of articles I'm reading from very large brokers and specialty carriers that are setting up programs for the boom in data centers. Now, of course, data centers are growing exponentially to serve the computing power needed for the boom in artificial intelligence. Turns out all the shit I asked Claude takes a lot to actually have them answer it. They're, clearscaping forests in, the Midwest and all over the country to build these really, really, really large data centers that utilize a ton of computing power and a ton of energy so that the computing power of the demands of AI are met. And some of the brokers out there, specifically the publicly traded ones that release their earnings, have talked about a boost in their revenue through Q1 of 2026 because of unexpected organic growth related to data center. What they really mean is they're writing a shitload of insurance that is coming at a still somewhat higher price relative to the overall market conditions because you have huge projects going up. And when I say huge, I'm talking data centers that are the size of 1 million square feet. These are Amazon warehouses and distribution centers, and they might have two or three on a plot of land. And because they need the land for cheap, what do we know about these data centers is that they're being put in the middle of fucking Iowa or, Ohio, or they're being put out in remote places because the land is cheap, and they're being constructed of, from what I can tell, they're being constructed of masonry non-combustible materials, meaning they're not stick frame habitational sites, but they're huge. If you think about $250 a square foot times 1 million square feet, you're going to have 250, 300 million or $1 billion in value. Take that even by 10 cents as an average property rate, and there is a huge amount of premium. And so in a market that's coming off pretty good catastrophe season, like hurricanes, et cetera, that has bolstered some positive results in their property market, they probably are having good capital at their behind, and they want to deploy, because at face value, while the sites of these might be remote, they probably are relative to habitational construction of frame stick. They're probably a lot better. Data centers are going to be very well protected. They're going to be made of concrete. The real problem with data centers and their insurability is probably going to come down to the values. If you got a $300 million building and you're going to be stuffing 250 million of computer equipment, by the way, that computer equipment, if it burns up, there's a 9-year wait or something like that to get it replaced. So the real probably concern is the values. And so I think, the brokers I'm hearing out there like Marsh Hub and some of these folks, they're putting together consortiums and layered programs and probably pulling capacity. And what they're doing is they're just building a builder's risk like property program. They're grabbing 9 carriers to share on a quota share basis. They're slapping their name on it with a form they used to have that they call data center expert, and they're selling it because I think this is pretty desirable property. So as I was thinking about this and how I could talk about it in the form of an episode, I wanted to start with something that is at the heart of these projects, and that's builder's risk insurance. Now, my disclaimer for builder's risk insurance is I may sound confident, but I don't know that much about builder's risk insurance. And this is maybe a nod to you brokers out there that are in the middle market and work for mid-sized or sophisticated insurance carriers. If you got big-time clients, manufacturers, construction companies, et cetera, and you have the ability, much like you maybe do with your cyber liability placements, this is maybe an opportunity to sub it out to someone who knows the space. And that's where I was very blessed and fortunate at my old firm. We had some folks within our construction unit that were builders risk experts, and they became very, very experienced. Now, it served their interest. Builders risk, much like the property market, has been under duress, meaning the rates have been high, specifically for things like frame construction habitational. And so they were making a, a, a good amount of commission placing these policies on behalf of other brokers. Think about a separate funnel for you brokers out there. Think about a separate little side business for prospecting. All you have to do is answer the phone and place a policy one time, and you have to do it right, and you can make a nice little commission hit. And so I was always glad to give that premium away because I was scared. And the reason that I was scared is I think, if you think about a new construction of a facility, Think about even like if you built a home, your home is exposed more so to the elements. You're running electric to it for the first time. You have multiple contractors in and out of it. It's a somewhat of an attractive nuisance because it's an ongoing construction site. You have plumbing. You might not have a roof on it right away. Construction period is one of the riskiest time periods for a property loss that exists. So if I'm running power to it the first time or I miswire something, your building or construction is at most risk during that period when it's being built. And so the riskiest time that for my customers is probably the biggest project they're undertaking in maybe a 5 or 10 year period. I worked a lot with manufacturing. If you decide to build a $30 million new manufacturing facility, you've got a lot of eggs in your basket. You probably got financing. You probably have already planned on the need for it before you decided to build it. So you're saying when it's done January 1st, I've already got the first 12 months of what that facility is going to do. Maybe I'm selling contracts on it. It is a lot of risk to take on at a time when the risk is high for the construction of the building. So I was very blessed. I was able to pass off these kinds of risks to a separate team. But I was smart enough to pick up some things along the way. And while I do not claim to be an expert in this space, I think there's some things that really keep in mind because again, I don't think it's appropriate at this level of consulting to just do like the Aon model. Well, we've got a person who specializes in every single thing. Well, your client might appreciate that. However, buyers, they don't want to necessarily talk about the most important thing with their in their life based upon 5 years of you getting to know them with a guy that lives 9 states away just because he's an expert at that coverage. You need to know enough to be dangerous. You need to know enough to talk about things early on in the process so that when you hand it off to your colleague who specializes in builder's risk, you're not handing them something that's already, behind the 8 ball. So, what is a builder's risk form? It is going to be a specialized property form. Traditionally, not going to include liability, but it's going to be a property insurance form. And it's going to have the same triggers for real property, fire, wind, hail, those types of things. However, unlike ISO property forms, there's a lot more variation between market to market. So it is a policy that you have to look at a little more closely. It also includes some very important coverages that mimic what you see in a property policy, but aren't spelled out the same. For example, the term soft costs in a builder's risk policy speaks to the costs that you incur in the event of a loss that are income related or future income related or expenses you incur. It's a lot like business income for a building that's already completed. However, it pays for future expected types of expenses and income. So if I was planning to build an apartment complex and it burned down and I estimated the rent payoff over the next 2 years, and now my apartment complex is going to be a year delayed, it's going to backfill that loss of income based upon what you expected to make. So very business income field, but costs very differently. It also has the ability not to be written on an annual basis. It can be a 3 month policy. It can even be an 18-month policy. And we're going to talk a little bit about when your builder's risk policy ends and when your property policy kicks in, because that's an important consideration. And again, I'm just talking about the high level things that I was prepared to talk to when my client looked at me and said, "Hey, we're thinking about pulling the trigger on this project." These are the things where I would talk about on the front end and say it's important that we get an expert brought to the table. So the other thing that came up a lot because my clients would talk to me when they've engaged a builder or starting to get bids. I had a client who would get 3 bids every time they built a facility. Another thing that came up is you want to see that bid contract or the bid language as soon as possible because most of the time my clients when they were putting out a construction project for bid, they didn't necessarily have the appropriate, if you win this bid, here's the insurance. Or they would find that once they selected somebody, the builder would want to come in and say, well, we got builder's risk coverage. We got builder's risk coverage. And I'll keep it simple for you brokers out there. You want to have the builder's risk policy in the name of the owner of the building. And it's not just to make sure you get the commission for the placement of the policy. Number one, and it's the biggest one, if you've ever been through a claim is a pain in the ass. Imagine arguing with your insurance company at a devastating fire loss for your half-built manufacturing facility, and the insurance company saying, before you go any further, I actually can't talk to you about settling this claim because you're not the insured on the policy. Let that soak in for a second. It's my building. I hired this guy to build it, but I am not the owner of the policy. If you're insuring a $30 million build or even a $10 million build and it's your money paying for the building and it burns down and who cares whose fault it is or how it happened, you're not the one who's going to be getting the check from the insurance company. Heck, you're not even the one who gets to argue about the amount. So number one, first and foremost, I told all my clients, no matter what, even if the builder says, I got this great policy, I'm in the business of building, I've got a blanket, because a lot of times these general contractors have a blanket builder's risk. And that allows them, since they're in the business of building, to just schedule projects on a blanket policy. And because of that size and the leverage they have and the size of their business, they oftentimes get a really kind of good rate. However, you are giving up, unless you specifically modify the policy, you are giving up rights as an insured, because you're not an insured. You might be a loss payee, but you're not a first named insured, which provides the most rights under a policy. So owning the policy, make sure that you have clear understanding of what all is included in the policy. For instance, if I'm one of 9 projects that the general contractor is going on, I might be scared of limit exhaustion. I might be scared of terms and conditions. But if I have my own policy, I can design it. And even if it costs a little bit more, you might be able to offset that within the bid project itself. But number one, the first reason to have your own policy is for the control, not only of the design, but also of the potential claim payment should it get that far. The second thing I want to talk about is carrier selection. And I talked about this a lot. Again, I spent a lot of time on the front end talking to clients when they were going through new construction. And a lot of times there's 2 things I would look at. Is this a remodel, or what's the size of this construction? Are you just putting like a new maintenance facility out back 200 feet away from your main facility and it's going to be $1 million project? Be mindful to at least look at your current property insurance to see how that language reads for remodeling. It is oftentimes very gray on what's a remodel versus what's new construction. So if you're doing an addition or a remodel, it's not always clear if you want to have a builder's risk policy. If you're doing a small outbuilding, oftentimes, if you have a large property placement, or if you have a meaningful relationship with your property carrier, they might be able to absorb that. They might be able to give you written confirmation that the property policy will extend. But then you have to think about it. It's important to look at it, because your client's expecting you to say something, and they're going to be expecting you to say, well, if I could get it for free under our property insurance, why wouldn't I do it? And here's the reasons you wouldn't do it. Number one, if you have a large property deductible or a large waiting period, you can oftentimes buy, especially for smaller projects, a builder's risk that is going to have a much, much smaller deductible. I oftentimes had clients who carried a $100,000 property deductible. And if they were building a small building, they might not want to have that. They understand that the risk is high of a loss during construction. So they don't want to carry that 100K over to have that. Number two, sometimes, especially if you're not building high risk structures like frame or habitational, you might be able to achieve a better rate on builder's risk policies than you can secure on your property. If you're manufacturing food in an unsprinklered location and you got a 20 cent rate, and you're building a masonry non-combustible separate side building to house inventory, that might be 5 cents per 100 as opposed to your 20. So why would I extend my deductible on my property policy that's $100,000 and pay a higher rate for the additional values that I'm going to be constructing? And then lastly, specifically if you're a tougher to insure property risk, think about the carrier overlap. Yes, there's always benefits to having the same carrier on multiple lines of coverage, because specifically in middle market, that bundled approach is going to allow you to have the leverage that comes with your total premium spend. AKA, the $1 million I spend on my casualty lines is going to be factored in how they deal with me on other lines of coverage. Even if my builder's risk is 10 grand, I know that I've got the force of my $1 million relationship that's performing well. But the devil's advocate to that line of thinking is, if I agree that I'm most susceptible to a loss during the construction period, do I really want to take a $10,000 policy or not take a $10,000 policy and risk having $1 million loss that could jeopardize or put a big scar on my record for a temporary policy for one time that is now going to be seen by the same underwriter who is negotiating my $1 million property and casualty program? So I oftentimes looked at it both ways. I would talk to my client about it. Do we have backup solutions? Are you a highly desirable risk? Or is it just not worth it for us to potentially have that exposure, and we should go get another carrier on the books? Because a lot of carriers will write builders risks, even though it's not the same appetite as they have for middle market. And then the last piece I want to talk about on this concept, I told you, I didn't lie. I knew enough to be dangerous and then pass the buck. And I highly recommend that for these types of situations. But the last piece is final completion and occupation. I learned this when I was working with a large food manufacturer that had a very high property insurance rate, but their builder's risk was really cheap. And it was with two different carriers. And we were looking to say, how long can we continue to extend and run our builder's risk, even though we have occupation? We were starting to install equipment in the facility. We were starting to have people there every day, but the lines weren't running. And we found out because the rate was half on the builder's risk that up until we turned those machines on and start producing widgets, we were actually okay to keep using the builder's risk policy. So we extended that policy for 2 more months at half the cost. And this is on $100 million of values because all we were doing was installing equipment. I think the rule of thumb is I got the final occupation certificate from the general contractor. Let's cancel the builder's risk and let's turn it over to the property policy. Well, your property carrier, depending on who they are, might want to start charging you for the endorsement for adding $100 million of values, even though you got $5 million of values working its way up to $100 million and you haven't made a widget. Well, let's extend that policy as long as they're comfortable with the occupation until the last possible minute before turning that off and turning it over to the property carrier. And the last comment is, if you have a really big relationship with your property insurance carrier and you have a new building coming online 9 months into your property insurance, it never hurts to ask, hey, property insurance carrier, I'm going to update these new values, which are slowly growing at the next renewal. Would you mind just scheduling this location, including it in my blanket limit of property insurance? But why don't we just true it up in 3 months instead of you endorsing a $40,000 premium edition prorated for 3 months? I was very successful in get carriers saying begrudgingly, as much as they want that money, they don't want to piss you off 3, 4, 5 months away from the renewal. You can't know unless you ask. And so those were some of the things that I did. And keep in mind, this is a coverage that requires a good expertise, but always important to know enough to be dangerous and to do the vetting on the front end. Your clients and buyers out there, you can probably speak to this. They know, like, and trust in you. So they don't want to just be passed off at the mere mention of something. They want to talk through this, and having an understanding of the risks and considerations is very important.